So rule number one, we're going to activate these day breakers. In TradingView, you can activate them from settings. Session breaks, it's going to be under appearance. From MT4, you can actually get them from right-clicking under properties. We're going to look for, it's going to be under common, the show period separators. That'll give you, to break it into daily sessions or a full day's worth of candles. If you're looking on the hour time frame, the second thing we're going to do for this is we're going to wait for a new day's open at wait for the new day to open. And the new day does open at 5 Central Time, but what we'll do is we'll wait for Tokyo to start, which will be 6 p.m. CST or 7 Eastern. So we wait for that so it can print out these lines for us. Third step is we're gonna look for the previous days. Open, which would be, go back to TradingView, which would be, that's the next direct, the next square. These lines also do play as support and resistance, as you can kind of see. Price need a big counter to break through it. If it starts, let's say, it opened today in that area, it dropped a bit, it comes back to retest. Usually it plays as a support and resistance. So it's probably going to take a big candle or a lot of momentum to push through. So once we find the previous day's open, we want price to break So we'll be looking for price to break the previous day's open. Then we're just gonna look for an entry reason. So we didn't dive into this part yet, but that'll be the fifth step, is to look for an entry reason. So when we come back over here and I give you guys an example, our entry reason here, we'll have to actually go to, let's put a mark there. We're gonna go down the same thing. If you guys are familiar with the videos, we go on top-down analysis. We start with the higher time frames, and then we're gonna work our way into the lower time frames to look for our entries. So now we have us we're looking at this area here, not current price, but this area here. So we have us a criteria for this trade. We see price open here, it dropped lower, and it broke the previous day's open. So at this candle here, what we will want to do is we're going to go back. We're going to go down to a smaller time frame, either the 30 minutes or the 15 minute. Let's use 30 because it'll be quicker to find that area. Yeah. So we'll see when it broke this area. I always tell my guys, tell you guys, big candles, it takes big candles to break support and resistance area. Big candles. You guys can also see how the formation is there. You can see that it came down, it respected it. Came down, respected it. Came down, it did break it. But on the other side, it respected it, showing us that this area has some type of significance. I like to say that it's fortified. It's like concrete floor or a ceiling. So when it came through, it took a big candle. That's going to be our entry signal right there. So we can either, the safest thing is to wait for the next candle. As soon as that next candle started printing, we could have took the trade to the downside. Now, as far as stop loss, you want to give it room. So I'll try to make it as easy as possible. I want to say it does depend on which pair, but you generally want to kind of have it above the current day's open. So we would have had a stop loss somewhere about here. We're looking about a 35 pip, 40 pip stop loss. Holding this trade though would have gave you 120 pips. So you would have had a 3-to-1. As long as you trade with some risk to rewards around there, a 2-to-1 to 3-to-1, you don't have to worry about blowing your accounts. So you did give a little bit more of a room. I seen a session from another trader today that was kind of breaking down how most retail traders use generally about a 20 to 30 pip stop. And that's why they get caught in a lot of the noise in the market. A lot of this up and down. They may have the direction, or I don't know how many times I know I have where I have the direction right, but I put a big lot size, or I have a tight stop, and it hits it, then it just drops like crazy. So giving it enough room and dual cord does allow the trade to work and progress. So stop loss, as a rule of thumb, you want to use it above the previous day's open, or excuse me, the current day's open. So let's jot that down real quick too. So we look for entry reason on smaller time frame. It can be any reason. You guys aren't familiar with candlestick patterns as far as single candlestick patterns, check out the Candlestick Bible. It show you everything with engulfings, 3 right soldiers. And then if you want to get fancy, you can also use like your indicators. If you use anything like Bollinger Bands, stochastics, those are all what we would call confluences. So you set up your initial trade using this strategy, and then you can add what I like to call overlays or confluences, and they give you a higher probability to that trade to work out. So we're going to be looking for entry reason on a smaller time frame, i.e. 30 minutes or 15. I'm looking for a candlestick alert or signal, or confluences from your indicators. So rule 6 is going to be placing the stop loss behind current days open. Excuse my spelling of it. Place the stop behind the current day's open within reason. And I'll explain that. So let's say, for instance, this example. We wouldn't take this trade, and I'll add that to the rules as well, because it never came back up to retest that previous day's high. We know that this is a downtrend. But as an example, let's say that for some odd reason, we got in the trade. Say for some odd reason, we got in the trade. Let's say we got in the trade late. We didn't see this. We wasn't at our computer at 6 o'clock. So for some reason, we got in the trade earlier. This is just an example where you don't want to, basically what I'm saying is you don't want to have your stop loss too far. Everybody's learning right now, so I can't say common sense, but, critical thinking. If we're trading like Euro USD, you're not going to have a 60, 70 pip stop. I have a little sheet, And you guys work with me and bear with me because I'm getting more organized. I got information all over the place. But I got a sheet that'll show you the daily, the amount that the pips move per day. And you guys can base that. So if you see, for some reason, if the previous time that you enter the trade, or you just thinking, say you switch over to GBP USD, we can use that sheet to cross-reference and see, okay, it's showing me based on the current day, the time that it broke the previous days. Okay, and that's how I can explain it. Let's say that this line was, we broke it and it was way down. Let's say this line was way down here. It's about, let's say 50 pips. And you see price gave a big red candle and it broke it. It came back and retested. You wouldn't want to have your stop 50 pips because that's showing some type of impulse in the market. So that was a big momentum sweep. Now the price generally with that big of a candle, it's probably going to continue to the downside, but it could also come back up and retest. You don't really want to get yourself and then change the whole, it could exhaust out the momentum to the bearish, reverse, and now you sitting there kind of in a naked with a huge stop loss that didn't make sense. So for instance, if this previous days is low, but for some reason momentum shoots real heavy, it gives you an entry. You just want to look for a candlestick pattern or somewhere this you're going to be able to base your trade. So with that being said, I'm going to give an example to make it a little bit more clear. So we have, let's say that this is the previous day's open here. So this right here is the previous day's open. Actually, we'll do it here. So we got the previous day's open. Now the current day open here. Now we see price do something like this, give us a, say it gives us a drop, it starts a trend, and you're like, okay, it broke down. Maybe getting my setup here. It does something like this, it drops heavy. Well, following these rules, we'll wait for the pullback. And it gave us an entry. And it's starting to drop down. So we wouldn't want to have, the rules is to have your stop based on the previous day. Let me change the color on that. The red is going to be the previous days. But this is a huge gap in between. You don't want to set yourself up like that. So I just wanted to go in more detail on that. So what you'll do is instead you'll put your stop above the current days versus putting it on the previous days. So they give you like a 20 pip stop, and we'll see the price probably continue its trend and ride that thing down. So the last portion of this strategy, and we'll recap real quick. And what time is it? Yeah, we still got some time. We'll dive into a couple other things. The last thing on this strategy is going to be the take profit. So a lot of people I have, they come to me and they're basing a lot of their trading on, I wouldn't say bad habits, but a lot of the things that's out in the industry. There's some things that's psychological as far as, you know, not wanting to hold your trades, wanting as soon as you see the profit, take the profit. So what I'm trying to build and get, you know, all you traders in the habit of is allowing the market to pay you as long as it's going to pay you. I always use the analogy, if I have, let's say, for instance, we got a tycoon on top of a skyscraper and he's throwing money down. He's throwing money down. There's nothing wrong with it. He says you can collect as much as you want. Just pull up your wheelbarrow. Well, if you have unlimited room in your account say you got a van or something, a truck that you can throw all the money in. Why would I leave until he's done throwing the money? So a lot of times we get nervous in the pullbacks, not realizing that this is probably the start of the trend for the day. The market does have to correct. That's how the market moves. So you have an impulse move, or you have, like, this would be more of an impulse move, but you have drop, basing, drop. That's how the market runs. Nothing goes up or straight down. So if I get in and I get an entry, it gave me my entry here. What I'm gonna do is allow this trade to progress and work. If it pulls back, that's fine. As long as I don't get another candle, especially here. It goes back to what we were just saying. You have to see big candles to break zones. You guys see there's another previous day. This big candle took it to break that support and resistance. So as long as I don't see price coming back up and covering, let's say 50% of this previous candle, then I'm gonna hold that trade. As you get a little bit more confident in your trade, you start picking out sniper entries, or it starts getting fun. You start kind of stalking the market. You make the market your prey. So here I'm gonna go ahead and put in another lot. I may even put it in with a bigger size, because now I have this one in profit. So as long as I'm not going crazy, I make it add like another 0.1, another 0.3, and I'm putting in here. This second trade is going to be paid for by this first trade. So even if the market sometimes the market likes to fake traders out, so it may pull up a little bit more. That second entry may be in drawdown. The first one, it may be eating away about the profits, but all in total, I may still be in profit, or I may just be in break even. So I'm able to hold the trades and give them time to work. And the market, that goes into patience and having a wherewithal, or just big cojones. So then the market rewards you for that. It drops down again in another 75 pips. So you have the first trade of 150 pips. You have the second trade with your big lot size coming in at 75 pips. Now you multiplying your returns and you're compounding throughout, allowing the trade to work. So another question would be, so that's targets. There's generally not a target. You let the market tell you when it's time to leave. So even here, like, it's easy to spot this out because this already happened. So I can say, hey, you should have just held it. But like, if we didn't have this down move and we seen these big, nice spike ups, this could be a reason, an indication to say, hey, let's get out the market. So it comes back to self. What are some of your goals in the market? At this point, are you satisfied with the profit? At this point, did you add in another entry? You start asking yourself critical thinking questions. How am I looking this week? Okay, I only have this particular trade running. I'm already up 10% this week. Why am I hesitant and why am I trading from a position of fear and not, dexterity and endurance? I should never trade. If I'm fearful for the trade, close your trades and get out, rethink. That means something's wrong. You start building up like kind of muscle memory and your intuition on the charts. So besides the candlesticks, you start listening to that gut feel, like, man, this is coming back. Let me get out. But you always use logic on top of that. You don't let these markets push you around and bully you around. We control the market. We control our investment, which allows us to control the market. The benefit that we have, and why a professional or a good trader is able to outperform the market and even hedge funds, is because we don't have to trade every day. We don't have to trade, or we don't have to take every opportunity. If this sets up and I'm just not feeling it that day, I got things going on, I'm cooking, I'm at the house, kids running in and out, I don't have to risk my money. Once you start thinking with that mentality, it becomes easier, it becomes simple, it becomes fun. You just get in the market when you want to, you trade how you want to, and you have the patience to see weekly by week. You start seeing the numbers. The numbers do the work. We don't this isn't another job. Well, it's a business, if anything. So we're not here to be slaves of the charts. We're not here to stress ourselves out, gray hairs, by trying to learn how to trade. We want to see each week, you know, if you get an extra $100, $200, that's more, you know, that's better than having to go bust sweat or hit that clock for it. So that's kind of a little bit of mindset into this strategy. You know me, I'm always step on my soapbox. So 7 for the exit. We're just gonna put until the market stops paying us. What'll happen is some trades you'll get so deep in profit. We get tricked out a lot because we like to look at these smaller time frames. But just think, what if you were to catch an entry on one of these dailies and you was to catch it from down here and you just held it? The market did almost come back to your entry, but it never hit your stop loss. So you just held it. You could have held this thing for weeks. And it's just paying you. Now you're able to, okay, I'm up, let's say $200-300 in a week and a half on this one trade with a small lot size. Now I can look for other opportunities in different pairs, and this trade is gonna be paying for them. So you could have rolled this thing up for almost a month and a half. So out of that, I want to say that it doesn't take a high investment to get a high return, or doesn't take high risk. It doesn't take a lot of risk to reap a high return. It just takes a little bit of patience and finesse. The second thing is text messages. But the other thing we want to look at, so it does take a high risk to get a high reward. The other thing is, oh, okay, that's what I was going to, excuse me. I was going to train of thought, but this is easy for me to say, and I want to break a misconception because you guys will see a lot of people showing y'all fire techniques, but they always trade on what I call the left side of the screen. It's easy for me to show y'all what already happened. The market, in a sense, is random. So we want to err and we want to respect the market. I can show y'all all type of patterns, strategies, and be like, man, and then I place the blame on you instead of me as an educator. I'm like, hey, you didn't do this, you didn't do that, when really it's just the market is kind of random. So I give you guys these little stints, and I go on these little soapbox talks. That way you can get a understanding of what we're diving into in the market. As long as we do, risk properly, we look for those 3-to-1 trades. We're following set risk protocol, and I'm gonna show you guys one. We use our new members. And then I ask you guys, we're gonna recap real quick on over the strategy, but is everything I'm saying so far making sense? Does anybody have any questions on anything before we go on to another topic?
No, it's making sense to me, especially since I'm really new to this. It seems like a really good, easy strategy where everything else I was not understanding. You know what I mean? Trying to learn all these Fibonacci's and all this stuff, methods and things of that nature. I'm like, okay, but no one's willing to show me. So this one seems like a pretty easy strategy.
It is. I'm what you call a momentum-based trader, and to be honest, I'm not going to diss on too many people's different methods, but a lot of that stuff is hindsight. It's overcomplicating your trading. Where price goes, that's where we want to be. The banks and hedge funds are moving the market because no one. If we put all our money together in a pot, we can't cause one counter. So we just want to be in a position to flow with the markets and flow when the big boys making their moves. And I sent this out to, I think that's Miss Eve I'm talking to, right?
Right.
Well, It's a pleasure to have you with us. And